What's happening, guys? Welcome to another video. Today I'm going to be going over a 5-minute scalping strategy that you can use to start getting better results in your overall scalping. I know a lot of you guys scalp, but do you do it successfully? In this video, I'm going to be sharing some guidelines and some tips that will enable you to get better results so you can scalp more effortlessly. Stick to the very end because I also share some trading psychology tips as well that will enable you to put it all together and become a better scalper and help you manage your emotions. Let's get to it. So as we're getting into the video, first couple things I want to go over is what is scalping. We're going to be going over some scalping misconceptions. These are myths that you may have heard about scalping that, might be the reason why you're not interested in scalping. We're also going to be going over some tools required for high probability scalping. And these are the core aspect of my scalping trading strategy. When we're done, we're going to be going over some trade examples, putting those tools together and showing you how it works. Finally, we're going to be going over some psychology tips for scalping. Psychology is a critical aspect of trading, and as a scalper, psychology is even more intensified because you have to be on the lower time frame. There's a lot of action. You have to know how to manage yourself and your emotions, and I'm going to be going over just a few tips that will help you in your overall trading, but also as you walk down the path of scalping. So taking a look at this, what is scalping? Scalping is a short-term trading style that involves opening and closing multiple positions on one or more currency pairs over the course of a day or a few hours. So as a scalper, you are in and out of the market. It's not necessarily about long-term of where price action is going. You are literally just capitalizing on short-term price movement. That is your job as a scalper. Generally, you will be spending a lot of time on the lower time frame, as that is where you will be executing, trying to get low risk opportunities and just in and out. That is the main thing you do as a scalper. At the core of my scalping strategy, tools that are important that you want to use, that's what we're going to be utilizing, the 5-minute. And, we'll scale down to the 1 minute to go over some examples as well. 25 to 30 pips minimum. It does minimize the amount of time that you have to go in the market or how frequently you have to go in the market by just, getting one high probability trade setup, right? That kind of gives you a big bulk of, something for the day or the daily range, you move on. So 25 to 30 pips is the minimum objective in terms of profit, which means that you will likely also be risking, 25 to 30 pips as a minimum for your stop loss. We're going to be using key levels. We're also going to be using London high and the London low. We're going to be using liquidity and time concept. So let's head over to the chart, putting all of this together with some trade examples. When it comes to scalping misconceptions, you're going to hear a lot of things. First thing is you have to take multiple trades a day. You don't have to take multiple trades a day. And when I scalp, I give myself 3 strikes, which you might have heard of in some of my previous videos. I talk a little bit about that. I don't take more than 3 trades a day. Sometimes I don't even take a single trade a day. So scalping is usually very high intensity. There's a lot of, ins and out of the market, but it doesn't necessarily mean that you have to do that. If that's not a way you like to trade or you like to scalp, you don't have to scalp like that by any means. That's the beauty about trading, guys, because you can make it your own, right? You can make it fit you. 2, all trades are 1-to-1 risk to reward. This is definitely one of the biggest things that turned me off from scalping, years and years ago, because I always wanted to scalp. I met some really successful traders who were great scalpers, but as a swing trader, spending time on the higher time frame, I know that I can take a trade 1 to 3 or 1 to 5 risk to reward. But as a scalper, risking, $1 to make $1, 30 pips to make 30 pips, and it just didn't make any sense. But what I came to realize is you can actually implement strategies or scalping strategies that will allow you to capture a lot more than just 1-to-1. And I'm also going to be going over that. Third, 5-minute or 1 minute time frame is just noise. The way the 1 minute time frame moves, the way that 1 hour time frame moves, the daily, the monthly, the weekly, it's all the same, right? Price action is the same across the board. The reason why the 5-minute and the 1 minute time frame are very, very important is because when you get the bigger picture on the higher time frame, you are able to snipe it, on the 5 minute or the 1 minute time frame, because those time frame will start to give you the first clues as to what is likely going to be happening on the higher time frame. But in terms of the overall long-term bias, you will likely need to pay attention to the higher time frame. So, which leads us to number 4. You are only paying attention to the 5 minute time frame, which is not true. If you're a scalper, definitely still need to pay attention to the higher time frame and get your bias from there. But there are some confluences that you can use on the lower time frame that will give you perspective of what is happening, and I'm also going to be going over that as well. So let's take a look at some high probability tools that are needed for scalping. Okay guys, so we're taking a look at the 5 minute time frame gold. The first thing you want to do when you come on the charts, any charts, is figure out who is in control of the market, and the 5 minute is no different. So right now we're taking a look at this market movement, and we can clearly see that buyers are in control as they are making higher highs and higher lows. And just from a foundational standpoint, when buyers are in control, they are targeting the highs, right? The highs are the major points of liquidity. And when sellers are in control, they are targeting the lows. Those are the main areas of liquidity. The next major thing that you want to take a look at is what happened during the London session. The London session will give you an additional confluence in terms of bias for the day. So taking a look at this here, we can see that the London low, which is the lowest point in the London session, we see the market rallied all the way up here till about 6:20. We started to see liquidity die, which is pretty standard, right? The London session will, really push in terms of liquidity between the 2 a.m. to the 5:30, 6 a.m., 6:30 mark. And right before the New York session starts to come in, New York pre-market or the New York open, you start to see a slowdown and generally a pullback. So right now, the next thing you want to do after identifying who is in control is you want to figure out a key level, an area of interest. How do you do that? So taking a look at this example here, we can see that this area price really struggled, and we started to see a nice solid push to the downside, a big strong bearish candlestick. And in order for price to break through, we have to see a big strong bullish candlestick. So when I take a look at this, right, that tells me that this is a key level. This is an area of interest, right? You want to pay attention to that. But more importantly, this is still a buyer's market. So plotting this key level, the one thing you want to do is, as sellers are coming in, wait for a reaction around the key level. See what's happening. Wait for price to start turning around. Let's take a look as we start to see price, react at this key level. So it's about still 645. And we start to see price, really bounce off. So taking a look at this candle right here, let's go over here. So this is the 730 mark. Coming into the market, doing my analysis at about 740, we're seeing price really bounce off the key level. So what I would do here is essentially take a long trade. Orders are in place, 30 pips stop loss. We're going for a minimum of 30 pips. And as you can see here, right, the trade played out perfectly. So we set a 30 pip stop, 35. You can also do a 25 pip stop loss as well, but I prefer 30, especially with gold. And now the next major thing is how you manage the trade. So the first thing I want to point out is let's take a look at the left right here. So this would be first take profit. And this is about 30 pips from where price currently is right now. So in terms of liquidity, right, the concept of liquidity, you start to look at where price is going. And from a buyer and seller perspective, when buyers are in control, they target the highs because the highs is where the money is at, right? That's where the money is at. This level is also an area of interest. That's a terrible line. Wow. But you get what I'm saying, right? So actually, let's just do this to make it a little bit more accurate, right? You can see that. Wow. Okay, so once the area of a major area of liquidity is tapped, the market generally tends to reverse. So with this trade, you risk 30 pips. Your first take profit is 30 pips, right? So if you have one standard lot going into the trade, you can take out 50. I usually tend to take out half of my position or a big bulk of the position in the first take profit. Reason being is because the first target is usually the most achievable. Close half my position or at least 40% of my position, move my stop loss to break even, and then let price play out to my second take profit. So I usually split it to about 3 positions, right? So the first position, easy to achieve. The second position at a next major high, and the third position, as you can see here. So these are areas of liquidity that you want to focus on, right? The highs, if you are being a buyer, and you would essentially do the opposite if you were selling. You would target the lows. When you do this, guys, when you do it like this, you will find that you do not need fibs. You don't necessarily need much on your chart. You just need to understand who is in control, key levels, and have the confidence and patience to execute when the market is reacting at your level. So we're taking a look at gold 5-minute time frame seller's example. And the first thing we want to figure out is who is in control of the market. Still, everything we talked about in the first trade is still very much applicable. It's just reversed. So here we figure out who is in control of the market in terms of buyers and sellers, and we know that market is trending lower and price is moving, to the downside as market structure is creating lower lows and lower highs. On top of that, we have the London high right here, which means that the London session from 2:55 a.m. was bearish and moved all the way down. And the next thing is identifying key levels. We know that past support tend to become future resistance, and we see that playing out right here. So we've identified our key level right here as a past support. Let's see how this plays out. So as we start to come into the market at about 7:30, we're taking a look to see how price is reacting at a key level. So 7:50, we're seeing price, really react at this level. What I personally like to do is I don't always like to get in as the market is at a key level. I like to wait for price to start to move away, as you will see in the trade. So taking a look at this trade right here, we see that it's a 30 pip, stop, very similar to the first one, as price is moving away from the key level, which was a past support becoming future resistance, tested multiple times, right? We start to put our order in, and the first scaling is 30 pips, and we move to an area of liquidity to the downside, right, for a second scaling. You could have also used this level for a second scaling as well, but I usually like my second scaling to be double or at least close to that in terms of my first scaling. So I settled for 50 pips on this trade here, and we take out a second scaling. You could have taken out your entire position here, or you could still have one more position, running while your stop loss is at break even. All right, guys, so we're taking a look at our final example on gold 1-minute time frame. First thing, like I said, it doesn't change, right? Who is in control of the market, right? That's still the main thing you want to figure out. And what you see here is about 3:14. We made the low in the London session, and we started to see an influx of liquidity come into the market, breaking the high, right? And that was pretty much the high, and we traded back down a little bit at about 4 and started to push to the upside. But this is the lowest point of the London session so far, and price is still above this level. So as we're going into the New York session, next thing that you want to start paying attention to is market structure in order for you to still figure out who is in control. Right now, we know that price has broken this high, so there's a strong chance for continuation. But you also want to pay attention to the little market structure, because that will also tell you. And the one thing about the 1 minute time frame, guys, especially with gold, market structure is key. You never want to be a buyer when the market structure is telling you otherwise. Right now, we have price creating lower lows and lower highs. So we are technically in a seller's market, right? And we see that price bounced after hitting the support, which is a key level that you identify as you start paying attention. You come in at 7 right now. This is about 8:30. So there's not much happening. You are patiently waiting for your opportunity to strike. You have your bias in mind. You know who is in control, or you at least have an idea of what to expect, right? All you're waiting for is for price to make its first move. Hence why we have the highs identified, because if price starts to do something different, we know there's a change in power. There's a power shift, and that's what we want to capitalize on. And we see the power shift right here as buyers now come into the market in a strong fashion. So this is where you as a trader look at your risk to reward. You can enter in terms of candlestick, right? You want to wait for, I like to usually wait for a bullish candlestick, something strong, something that gives me a confirmation that, hey, there is liquidity coming in, there is money, and buyers are now dominant. And that's exactly what we see as price, starts to come in here, and we see price move, 60 pips to the high. Like I said, you can scale out. Sometimes you can leave your trade, manage your trade however you see please. But this happened, within a period of 14 minutes, right? This is easily what you would call, just in market continue to move. So this is easily a 4-to-1 trade, risking 30 pips just off of some basic understanding of the lower time frame, and gathering enough confluence and using key things like London for your bias, right? And also identifying key levels and understanding the power shift between buyers and sellers, right? This is a very probability based approach, right? You have to wait for price to tell you what to do. And when you figure out if the probability is in your favor by using these confluences, it will give you a greater understanding of the story of price action, and when you should be acting and when you should be sitting on the sidelines. To wrap this up with some trading psychology tip, I want to give you one of the most important quotes in regards to trading that you will ever hear, and that is know thyself. Right? Which leads us to our first one. Know your trading personality. Know what kind of a trader you are, because not every system, not every strategy will fit you. As a scalper, you got to be able to make decisions on the fly. You got to be able to pull the trigger on the lower time frame in the heat of the moment at a rapid pace when, price tells you to do so, right? Whereas on the higher time frame, you're trading, you're working off 1 hour candlesticks, 4 hour candlesticks. So it gives you a little bit of a longer window, right, to make your decisions. Number 2, don't let the fear of striking out stop you from playing the game. This is a baseball quote that I love, and I think it is very applicable to trading. As a trader, you will not always win. As a scalper, you will be in the market a couple times a day. When you take a trade or you lose, don't let the fear of losing stop you from, following your system, stop you from playing the game, right? You have to come in and you have to do the exact same thing day in and day out, whether it didn't work yesterday or the day before. You can't change your system, right? Because you are afraid of losing. So you're trying to find something else. There is no such thing as a holy grail, guys. So this is very important. You have to stick within your parameters that you have defined for yourself, whether you are losing or not, right? So don't let the fear of striking out stop you from playing the game. We all lose, but how we come back is one of the most important aspects as a trader and as human beings. Number 3, manage your heart rate. When you are trading, especially as a scalper. Like I said before, you will be making quick decisions, right? So managing your heart rate means that you are there watching the trade play out. A lot of traders can't sit down and watch the trade play out, which is why some traders will tell you to set and forget. But as a scalper, you have to make quick decisions, so you have to be on your computer, right? So you have to learn to manage yourself, and one of the ways you can manage yourself is to manage your heart rate. And one way you can do that is breath work, breathing, really regulating your overall system. I trade with a heart rate monitor, and that tells me when my heart rate gets to a certain level. If my heart rate gets to a certain level, odds are I am moving away from my optimal state of trading. I am no longer calm. I am now becoming a little bit more reactive and letting what I am seeing in price get to me, and that is going to make me make poor decisions. So that's the video, guys. Thank you for watching. Thank you for tuning in. If you found this insightful, I want you to hit the like and subscribe button so we can reach out to a lot more people, and also so you don't miss any future content. My name is Emmanuel from LiveFree Effects. Hope you're out there living free. Peace.